Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Anthony Woolley, Head of Business Development at Ownera, an institutional-grade blockchain network for security tokens, or what some prefer to call digital securities. Anthony is also co-chair of the Global Digital Finance Private Markets Digitization Steering Group, a group of banks, financial market infrastructures, technology vendors, and FinTechs whose aim is to enable the interoperability or portability of security tokens between different blockchain networks. And it's the work of that group which is the subject of our conversation today, FINP2P.
Yep, thank you, Dominic.
Hello, Anthony.
Yeah. Good morning. Yeah, a pleasure to talk to you this morning.
Now, let's get to the heart of this. Lack of interoperability between different blockchain networks is clearly a problem which has emerged. Is that the problem which FINP2P is going to solve?
It does solve it, but in the context of digital securities. So over the last few years, I think there's been many initiatives that have tried to tackle the problem of blockchain and more broadly distributed ledger technology interoperability. And I think they have struggled somewhat. If you approach the problem down at the technology layer, you quickly run into many issues. How do you connect these networks many to many? How do you do atomic transfer of assets between those networks? All of these technical things. We approached the problem in a different way. We elevated the problem above the blockchain and DLT networks to produce a routing layer for digital securities. So FINP2P as a protocol understands what a digital security is and what it means to transfer ownership, make payment and handle custody of those securities. And I think by taking that approach, focusing on that functional domain, we very much tackle that problem.
But tell me, if blockchain networks pursue different technical solutions, shall we say, to the question of atomic settlement, how does providing that routing layer solve that problem if you want to purchase a digital asset on one network and then settle it on another?
So fundamentally, FINP2P can connect different institutions, different marketplaces, different blockchain and DLT technologies, and it's a routing network. So if you imagine you have a DLT marketplace with assets held on that network, what FINP2P enables you to do is extend access to that asset to investors on other venues and marketplaces. When they transact in the digital security, the record of ownership is updated where that security sits. So we're updating record of ownership of securities, not moving those securities physically, for want of a better word, between those DLT networks.
So the technical differences can persist without interrupting interoperability, right?
Correct. We're totally focused on digital securities, solving the distribution problem so that potentially any asset, whatever venue it's on, can potentially be distributed to any suitable accredited investor globally.
Now, I can see that interoperability, that portability is clearly a benefit. Are there any other benefits from solving the problem?
This is fundamental. Solving this distribution problem is really opening up institutional adoption of digital securities. You know, we've had a lot happening, as you call it, with security tokens, and then coming from an institutional background, I prefer the term digital securities. And that institutional adoption has really not been there. You've had public blockchains servicing the issuance of securities to retail investors. Once you can solve the distribution problem in the context of regulated institutional network for institutional investors, that really opens up the potential of this technology. And we very much focused that on private securities, where this is really the world's biggest offline market, as opposed to the public markets, who are actually smaller, but have a tremendous amount of liquidity. The private markets are offline, and this delivers many benefits across that ecosystem of the private markets.
And the beneficiaries, issuers get access to a different type of investor, investors get access to a different type of asset. Who's going to enjoy these benefits?
Yeah, very much so. I mean, the private markets at the moment are offline. If you have an issuance around, say, a private company, they may talk to no more than maximum 30, 40 investors, if that. There are assets all over the world looking for investors. There are investors all over the world looking for access to those assets. And at the moment, these have been locked up in fairly, self-contained, isolated, monolithic marketplaces in different jurisdictions. There has been a proliferation of private marketplaces, but with a lot of friction, and they've been successful in spite of a lot of that friction. This really opens it up so that, and this benefits all of the stakeholders in this ecosystem. So it benefits the assets looking for investors, it benefits the institution bringing the assets to that marketplace, it benefits the buy side and the wealth managers bringing investors to that network, and to the many service providers that can come into that whole FINP2P ecosystem, whether that's companies providing digital custody, transfer agency, settlement solutions, payment solutions. So it's really driving a new ecosystem that can take private markets online.
Mm-hmm. Now, you've been very articulate about the initial use case here being the private markets, for the obvious reason that they're fragmented and have lots of friction. You've also referred to the fact that public markets have less of that fragmentation, less of that friction, even though they're much smaller. Do you envisage this model eventually being applied to the public markets as well?
I've spent most of my career actually in public capital markets, building things like FX and fixed income electronic trading systems. And so one thing I understand is the sheer complexity of the 40 years of legacy infrastructure we have in the public markets. That's not just the technology, but operational, the amount of intermediaries that are involved, etc. And I think over the last 5 or 6 years, there are many people have spent a lot of energy working out how to apply these new technologies to the public markets, but it's a very heavy lift, right? And it's very hard when you're trying to work out how do you adapt all of that legacy. We're focused on the private markets, which are offline. We think it's an environment where you can develop private solutions for digital securities the way they would have been done 40 years ago if the technology was available. That's our focus. I think once these solutions are delivered and are being delivered in terms of taking securities online in the private markets, there's nothing in the technology per se or in the protocol that stops that being applied to the public markets, albeit from a practical point of view, the commercial implementations that are being worked on at the moment are not really geared to things like high frequency. But in essence, the technology could be applied there, but we think that the real value and the commercial value for now is in the private markets.
Now, talking of public and private, does FINP2P apply to public blockchains or just to private permission blockchains, or to both?
Okay, so you differentiate, say, the protocol from where our focus is and how we're leveraging that protocol. Fundamentally, FINP2P knows about digital securities. There's nothing intrinsic that would say that it specifically couldn't work in, say, a public blockchain environment. But with digital securities, we're focused on developing a regulated institutional marketplace. And those institutions we're working with for now want to focus that for lots of reasons around permission, call them private blockchain networks. In the future, there's nothing in the protocol per se that prevents it being applied to public blockchain networks. In fact, in the short term, we've already demonstrated that you can use FINP2P to transfer ownership of a security in a private blockchain network, but do the payment leg, the instant DVP, using a stable coin that may come from a public blockchain. So I think those two worlds over time are getting closer together. In the short term, the whole initiative is very much focused on transfer of securities within a permissioned blockchain environment.
Mm-hmm. Now, I brought up that public versus private blockchain thing partly because one of the major obstacles to institutions getting involved, for example, in cryptocurrency, is their concern about joining public blockchains where their transactions might be exposed, breaching privacy or confidentiality obligations. They don't know who they're dealing with, and so on. One of the ideas that's been put forward as a way of making public blockchains more accessible to institutions is by using cryptographic structures like zero-knowledge proof to kind of deliver some sort of privacy level. Do you have any thoughts on whether there are privacy enabling solutions which would allow institutions to get involved with public blockchains? Do you see anything in development at the moment which would make that possible?
I think privacy is one of a number of issues or topics that need to be tackled before you get widespread institutional adoption in that space. And zero-knowledge proofs that you refer to, mathematical structures that enable you to process data whilst it's encrypted. They have their own hurdles, as I understand it. I'm not a mathematician, but I understand in terms of scalability, performance, these sorts of things, challenges. So I think I can understand why there's a lot of people putting a lot of energy into solving the privacy problem in public blockchains, because it is a problem, right? Public blockchains are only pseudo-anonymous. And I think in parallel to that, there's a lot of other things going on in the legal and regulatory space that are topics to be tackled there. So who knows? I know these two worlds are converging more. I think, public blockchains were designed for very decentralized cryptocurrencies, and to many ways people are trying to adapt that to work with digital securities. Obviously the massive developments that started with Ethereum and now around DeFi, etc. So these worlds will continue to converge, but I think there's still quite a few technical problems to be overcome before you can see widespread institutional adoption in that space. Of course, when it happens, again, there's nothing intrinsic in FINP2P that stops it delivering these interoperability capabilities between, say, different public blockchain technologies.
Well, talking of convergence, obviously there's a convergence between the public and the private blockchains, between cryptocurrency and security tokens, digital assets, and I hard to disagree with that's what is actually happening. How long it takes is not clear. But what about converging with the way things are done in the public securities markets already? And the reason I'm asking this question is that, as you pointed out, the complexity of what goes on in the public securities markets is always a lot of intermediaries doing lots of different things at the issuance level, at the trading level, the settlement and custody level, at the asset servicing level. To go back to FINP2P, how many of those functions, by which I mean onboarding investors, onboarding issuers, admitting trading counterparties, doing the DVP settlement, collecting entitlements and so on, how many of those functions are built into the FINP2P protocol now, and how do you expect it to evolve in future?
Yeah, okay. So again, I think FINP2P as a protocol has the potential to handle the full life cycle of a digital security and the associated transaction and settlement of those securities. And we've already demonstrated when we launched the protocol in the public domain last month, how digital securities can be issued, transferred between owners, and how different parties can deliver. We demonstrated multiple third-party custody solutions, multiple DVP instant settlement solutions, and recently we've developed a protocol so it can handle simple indications of interest over that network. Ultimately, it understands securities. So, for example, you can use FINP2P to interconnect different exchanges, and you could have full trading of those securities in a secondary market on those exchanges, but extending access through the FINP2P routing network to, for example, investors on other venues and exchanges. So ultimately, it can do a lot. I think it's fundamentally, when you talk about the public capital markets, if you like, it's how do you get from here to there? And it's like, how do you migrate any large system or technology, a problem you're trying to solve with technology? You can either migrate what you have, or you can start with a new blank sheet of paper. And I think people are working at that problem from both ends. We're very much working on the problem of applying FINP2P to the private markets, which is offline. Very much we can focus on moving very quickly and designing this the way we think a digital securities network should be designed. Ultimately, we're bringing issuer and investor closer together, asset and investor closer together. And this ecosystem will have people adding services, call them intermediaries, where they add value, but not because they're there because of inefficiencies in the network. And you can imagine, I think, if we were, say, issuing private debt on FINP2P, and that was working well, and we had volumes of issuing private debt and equity, one could imagine that you might want to just issue, public debt using that technology, as opposed to applying that technology to re-engineer the public capital markets. All of these problems will be solved in time. I think, using DLT in a substantive way to transform the public capital markets will take many years due to that legacy, due to that complexity. And in the meantime, we think we can move in an agile way at a pace to take private markets online using digital securities.
Now, bringing issuer and investor close together sounds like disintermediation. If I was an investment bank or a registrar or a stock exchange watching this, I might be a bit concerned that my occupation is at risk. Is that what bringing issuer and investor close together means?
I think it means what it says. You're trying to connect assets with investors. In financial services, will always have complexity to it, and there will be many different types of companies adding value to that process of bringing assets and investors closer together. I think for different parties, they need to look at the core values that they add in that ecosystem, not because they're compensating for inefficiencies, but because there's a true value to be added there. So, we will always need, although the technology may record an immutable record of ownership of securities, which makes that very efficient in terms of being able to trace ownership of securities, you're always going to need people to manage those registries, provide, in the private markets cap table or registry management services. You're going to need ways that you potentially want to lend out those securities in the SEC lending market and so forth. So the process of disintermediation is one in which we're moving to a more efficient environment. And I think that, large institutions that carry out intermediary functions, different FMIs, etc., there are roles for them to play in that new world, but they need to look into it in terms of the core value they add to assets and investors, and not just that they've been making money because they've been compensating for inefficiencies in the public markets.
Now, many different companies adding value here. Just to be clear about what the protocol is and isn't doing, are you providing the functionality rather than the functions? In other words, are you providing an infrastructure on which lots of different providers can create, if you like, apps to deliver different types of services, maybe even services we haven't thought of before? Is this protocol infrastructure or is it function?
It does provide an environment, an ecosystem where different parties can provide different services. So in that context, it's an infrastructure. Again, it's a routing protocol that understands what a digital security is. I think one of the most powerful things it does is, if you've got digital securities running on a single DLT environment, what I might call a little bit of a monolithic marketplace, your handling of your security, the payment for that security are bound together, and anybody wanting to add services needs to comply with the technical complexities of that specific DLT network. What FINP2P does is it can interconnect different DLT networks, at the same time decoupling both the need to understand the specific DLT technology, but I'm decoupling the transfer of ownership of the asset from the payment for that asset and from the location of the investor relative to that asset. And so it does support an ecosystem where, for example, you can have one DLT which is optimized for managing the ownership and transfer of ownership of securities, and may be optimized for performance and also doing other things in the secondary markets. But that DLT environment, when somebody transfers the ownership, they can actually do the instant payment with a stable coin on a different DLT network, or with some other token backed by central bank money, or ultimately by a central bank digital currency. At the same time, you could also the investor investing in that security on that specific DLT marketplace could also choose a digital custody provider, which again is sitting on a different network. So, we demonstrated multiple digital custody providers with their key management solutions. The investor can say, well, I'm buying this security on this DLT network and I wanted it custodied by this provider and settled by this settlement currency. So I think that decoupling and the fact that the various parties connect just through that open source specification for the FINP2P API makes it more accessible to all, as opposed to parties having to know about a particular DLT technology or being bound into a specific marketplace.
Now, your last comments make me think that the people really at risk here are the central securities depositories. If you think about what they do, which is deliver securities against payment in central bank money through this centralized process, you're describing a world in which the payment leg, the cash leg, if you like, is decoupled from the delivery of the asset. It becomes completely decentralized. So it's a future in which these decentralized utilities are no longer relevant. You're not through this protocol going to recreate the world of CSDs with custodian banks as gatekeepers.
The way I would put it is that in this private markets with FinP2P, we're not going to recreate CSDs in their current form. But again, there are roles for parties to play in this network. For example, although the blockchain may hold the immutable record, you need somebody accountable for overseeing both that record of ownership. You've got all of the administration services associated with it, and again, for instance, how you're managing the lending of those securities. So maybe I'm being a bit diplomatic, but we're not recreating CSDs in their current form, but there are roles to play for people managing registries of ownership of assets and all of the associated administration and other services around those. And
I guess carrying the liability for loss of assets as well. Institutions want somebody responsible for that, right?
Yes, indeed. In fact, when you look at this and you look at the legal and regulatory construct around FinP2P, it starts to look quite conventional in terms of the environment regulated institutions are used to seeing. So just a very basic example is, if you look in the world of cryptocurrencies, they operate almost bearer-like instruments. If I lose my private key to my Bitcoin, I've lost my Bitcoin. That's not the case here, right? We are recording a immutable record of ownership of securities, but if something went wrong, then they are recoverable. They are recoverable in terms of if there was default, legal recovery of ownership of assets, so on and so forth. So we are using this technology to update record of ownership of digital assets, not to move them around like bearer type instruments.
Right. So if your cryptocurrency is stolen, that's it. But if your security token is stolen, there are ways of recovering it.
Correct.
Yeah. Now, where have you got to? You're at the pilot stage, I understand. When do you expect to go into full production?
Yes, so obviously we've been moving quickly. We've been hitting all of our objectives and milestones over the last year as we've developed this. We've proven the technology. We launched the technology last month and demonstrated all of the things that I've talked about, from issuance, transfer of ownership, custody, settlement, payment, etc. We're now starting to work with real-world assets in a pilot mode, so demonstrating how real assets can be issued on the FinP2P network, albeit in the very short term to fictitious or investors. But we will then start to move to full production later this year. One thing that's nice about FinP2P is it doesn't require everything to go live at once. So when we first moved to production, the way that FinP2P works is that each node on the FinP2P network, FinP2P node, which we won't go into detail, but not the same as necessarily a DLT node, but each node on the FinP2P network is run by a regulated institution. That regulated institution brings assets and investors to the network, and on the other side of the transaction, you have another regulated institution bringing in assets and investors to that network. So we can go to production with as few as 2 or 3 institutions and then grow the network node by node. So this enables us to go to production quite quickly and then grow it. And then you'll see in the next 2-3 years, it then growing rapidly in terms of then the proliferation of those nodes. And as that happens, once you start to get that growth, that flywheel, then you get that positive reinforcement of the network effect. You know, more institutions bringing assets, attractive high quality assets, attracts investors, which attracts institutions bringing high quality assets.
Mm-hmm. Well, as you say, network effects are going to be crucial to FinP2P really taking off. What are the obstacles to network effects kicking in?
Okay, so there is in all of this, it's been cognizant of what everybody wants, or put it another way, people's commercial interests, right? I think with FinP2P, what's attractive is it's providing an ecosystem where many different parties, whether they're buy or sell side institutions, exchanges, other FMIs, FinTechs, custody providers, transfer agencies, etc., can all play a role in this network in a structure that can support whatever commercial models they may have. And I think that's key. I think the industry has been crying out for this interoperability problem to be solved. You know, everywhere we look, you see press releases. Every institution's got a digital securities initiative running, but they're having, they're turning the key on the engine, but maybe the engine isn't running smoothly yet because of this distribution problem. So I think this network effect, I think a lot of people want this to happen, and I think we've developed this as an open source API specification that makes it easy for people to participate, and we're sitting in a relatively neutral position. And so I think that can help drive this network effect, and then we'll see what happens. I think, parties will be interested potentially in creating their own localized marketplaces and not connecting to FinP2P for wider distribution. But then they may find over time the commercial pressures to connect and achieve that wider distribution would then draw them in. So I think that there's various ways that network effects can be overcome, but I think we're pulling on the right levers to help drive adoption of that network over time, because people want it. It's in everybody's interest for it to happen.
I'm wondering if an evolutionary process needs to be at work here as well. And what I'm thinking here is that if you look back over the history of standards in the blockchain universe, you did get this multiple proliferation, I think was a term you used, of standards, and then you had this pretty brutal evolutionary process where people converged on things like the ERC20. Is that experience relevant to what's going to happen to FinP2P? Are you in some kind of evolutionary race against alternatives, or will different effects apply in your case?
Yes, I think what you see is that if you have a good specification or a good standard that solves a problem, but doesn't only just solve a problem, but presents the right commercial environment, the right commercial opportunities, you suddenly find things move very fast. I mean, how fast did we go from Ethereum being developed to security token offerings, and how fast, once ERC20 was proven to work, did people adopt it? Why did they adopt it? Because it was in everybody's interests who were involved in that to do so, and there was commercial opportunities there. I think that's, and there will have been many other technical developments, many other specifications that have quickly fallen by the wayside. So it is evolutionary in that sense. And I think that's the same with FinP2P. I think that, we produced it with an open source specification. We think it solves not just a problem, but provides the right commercial environment for different parties to contribute to. And we think that's what will drive its success. And the other thing that's very important around this space is the time axis. Also often people will put themselves in the room to try and develop a standard or try and develop perfection, but in the absence of the concept of time. And I think, often you see what are these, new specifications, new standards take off because they work and they become, like de facto standards, for want of a better word. So yes, it's evolutionary. We think that FinP2P solves a problem that needs solving for the industry right now, and that will drive its adoption and success.
Mm-hmm. The best is the enemy of the good in this field, as in others.
Yes.
Now, I don't know the answer to this question. I don't know how many blockchain technologies there are out there. We obviously know about, Fabric and Corda. Perhaps you do know how many are out there. But what proportion of the universe of blockchain technologies are you aiming to cover?
So with the way FinP2P works is that if you imagine a FinP2P node, it connects horizontally to other nodes to create the network. It has APIs, so for want of a better word, facing upwards that connect to applications. And it has adapters that connect downwards into different blockchain DLT technology. And so far within the GDF group that we run, people have developed adapters for Corda, for Ethereum, for Fabric, for Assembly, and for Stellar. And that's been driven by the parties in the group wanting to develop those adapters. In principle, there's nothing to stop adapters being built for any type of blockchain technology. It really just comes down to the time, interest, and focus of the companies contributing to the FinP2P initiative. But I think you can see the ones we built the adapters for at the moment. I haven't got the data, but I think statistically, covers the large majority of efforts that are out there.
Mm-hmm. Can I ask you now a little bit about how a specification like FinP2P sits relative to standards? Obviously, the traditional securities markets operate with a variety of structured message formats we call standards built to ISO specifications. I'm thinking here of Swift messages, of fixed messages, of FPML in the derivatives markets. And I'm wondering, A, what the difference is between a specification and a standard, and whether, as you look forward, whether the work that you're doing is some kind of alternative to standards, or it is a first stage towards the emergence through evolution of standards for blockchain networks, which will look just like Swift and FPML and FIX.
Yes, specifications and standards, right? I mean, it's kind of symbiotic, but you need both. The question is, how do they emerge? I mean, you mentioned FIX. Off the top of my head, my understanding is that the FIX protocol was developed by some major institutions in the 90s, from memory, and I hope I get this right, probably Citi, Fidelity, and JP Morgan. Now, when they developed that FIX protocol, I'm sure they developed it as a specification, and the industry needed it, and it became rapidly adopted, first in the equities market, then in FX and fixed income, etc. And everybody thinks of it today as a standard. So I think standards can emerge from successful specifications, and in that sense, you see specifications becoming de facto standards. And you see this happening more and more in the world we live in, the world of the Valley, and the large tech companies, Google, Apple, etc. And because everybody's working against API specifications to connect and intercouple different systems. But those specifications, the good ones, if they serve the purpose right, will evolve into de facto standards. On the other side, I think there is a role for open standards as well. I mean, we have an open source specification for FinP2P API, which we hope will come a de facto standard. But on the payment legs, there are standards for payments, and we'll adopt standards where they're appropriate. We don't want to reinvent the wheel, but we want to focus on the specification, adding value, because there currently isn't that solution for interconnectivity of digital securities across DLT marketplaces.
Can I perhaps unfairly ask you to be clear about something I think you just said, which is that API specifications will evolve naturally over time into API standards? Is that what you were saying?
The successful ones will, right? I mean, it's down to adoption, and when you look into those APIs and the detail of fields and attributes, etc., they become the standards, right? I mean, on a very simple level, if we develop a if we're talking about passing a country code, we'll look to ISO for the standards for that country code, within that API specification. So a lot of it will already incorporate standards in one form or another. But the specification of itself, when it becomes to a much wider adoption, then people will think of it as a de facto standard. I mean, at the end of the day, FIX is also a protocol. It's not a messaging standard, right? But it's now a protocol standard, for want of a better word. So those specifications that are adopted proliferate and become de facto, people think of as standards, right?
I mean, the reason I ask you that, because API standard sounds almost like a contradiction in term. You know, this device is meant to enable different systems to communicate effortlessly. But I suppose the world you're describing is you're going to have to make use of standard components to enable that process to take place. So the distinction between a standard and a specification naturally erodes through practice, through actually using it in practical environments. Is that right?
I think you articulated that very well, right? The boundary between the two erodes. As you say, the essence of APIs is that you don't, some would say you don't need a standard, right? You publish your API specification and connect to it. But the very process of many technical teams in different companies connecting to one another, they tend to look for the simplest path. And so what you tend to find over time is that different APIs develop standard ways of doing things, and you see a convergence, which ultimately looks like a standard. So I think what you articulated it well is the sort of erodes between the two, the definition.
Can I ask you specifically about ISO 20022? You know, if I was working at Swift, I would see the future of the securities industry lying in widespread adoption of the ISO 20022 standards. You see central banks pushing that, the European Central Bank most obviously. You see quite a few CSDs committing themselves to adopt it, yet you don't see that much actual use of it. And in the securities markets, at least, Swift is not forcing ISO 20022 onto the industry because the industry doesn't want to do that. They are doing that on the payment side. Has ISO 20022 played any part in your work? Do you think it has anything useful to offer to what you're doing now or in the future?
Yes, the payment space is moving incredibly fast at the moment, and probably faster than anything else, with what we've seen going on with tokenization around payments, what's happening with that potentially disruption in the commercial banking model, what we're seeing with stable coins, and then onwards with central bank digital currencies. Now, ISO 2022, if that can add value to that, then it would be good for that to be adopted, you know, and I would advocate that. And when we connect and talk to people about the payments end of FINP2P, then ISO 2022 is an excellent place to start. Whether it gets adopted in practical sense widely depends whether it solves the problems that people are trying to solve in transforming international payments. If it does, then it will drive adoption. If it doesn't, then it may form a more of a role on the side. I mean, let's see. It's in principle, ISO standards are a good thing. And people should adopt them where they work, where they help solve their problems.
Now, one other thing I noticed in that you're doing is making use of digital identities to identify the investors, the issuers, identify the assets. What role are they just central to achieving the levels of automation you need, or is there some richer story somewhere inside here about the value of digital identities as the markets evolve and make it easier for markets to grow? Or is it, I guess my question is your focus on digital identity just technical, or is there a long-term commercial strategy at work here?
I mean, there's a lot of people focused on the digital identity problem at the moment, and rightly so. I think FINP2P itself doesn't say anything specific about identity other than it supports the concept of claims against both assets and investors. And in that sense, it can support different forms and standards of digital identity. Ultimately, what FINP2P supports is the ability that at a point of a transaction, you can look at the attributes of an asset and the institution that's brought that asset to the network. So, for example, you know, which jurisdiction is that asset issued out of? Does it have certificates for regulatory exemptions, such as Reg D or Reg S exemptions? And when an investor is brought to the network by an institution, that investor will have attributes, do they have certification being accredited? Have they passed an institution's KYC, AML? All of these good things. And then at the point of the transaction, that's those two, the attributes of the asset and investor, are married together to see if that real-time transaction can proceed and complete. We're not interested in driving the standards around digital identity, but having a protocol that supports different digital identity standards as they emerge in different jurisdictions.
Now, just to come to the close of what we're talking about, there's an awful lot of things going on out there in the world of digital instruments, let alone the world of digital securities. You've got cryptocurrencies, you've got payment tokens, you've got utility tokens, you've got, as I say, security tokens, and you've got non-fungible tokens. Then you've got, of course, the whole world of traditional securities. Are there any limits in your own mind and vision to the instruments which FINP2P can encompass and support?
Yes, I mean, fundamentally, FinP2P has been designed around digital securities, otherwise known as security tokens. It's interested in being able to distribute and connect investors to digital securities sitting on various networks. It can, however, as we've talked about, the payment leg being decoupled. So FinP2P doesn't mind what that security is paid for with. Right, that I've talked about the fact that you could pay for that, complete payment leg of that transaction with a stable coin or a CBDC. You could pay for that security in Bitcoin using FinP2P. So in that sense, FinP2P is flexible on the payment leg, but in terms of the security, we've really focused it on understanding what a security is more broadly, and how to encapsulate that in a digital security. So we don't see it being used for NFTs or anything in the short term. We're really focused on digital securities, and then flexible means of paying for those.
So it'll encourage convergence, but on a relatively narrow front to start.
Yeah.
Now, I looked at, you're at the proof of concept stage. I looked at the 10 firms which are involved. I saw DTCC was there. I saw R3 was there. I didn't see a lot of other what might be called established or establishment firms there. Now, any enterprise, you can, like any person, you should judge just as much by their enemies as their friends. Who do you think are the enemies of this innovation, whether they're conscious enemies or not? And are those enemies the same organizations as the ones likely to be victims of of developments like this?
So the first thing I would say is that the parties you're aware of are the ones that participated in the launch of FinP2P, and we're talking about their efforts to technically integrate some of their systems to FinP2P at the launch. However, the group that I have the privilege to lead has over 70 institutions in it. So within that group, we have some of the world's largest sell-side, buy-side institution, the world's largest exchanges, clearinghouses, other FMIs, you've seen tech providers, DLT technology providers, FinTechs, and also some leading international law firms. So FinP2P is very much supported by a wider group. We've developed this without being very public about it. We're aware that over the last few years, there have been DLT initiatives that start with a press release and then work out what they're building after that. We very much, with the group, took an approach that we will build it first. When we did the technical launch, we talked about the technical contributors and the parties that have contributed to that. As we get further into the pilot and ultimately production, then we will talk about the institutions that are party to that. So it is a very wide, diverse group. That group has been very active over the last year. And I think that's a testament to the fact that for all of those companies, they see an interest in participating and helping make this successful. And as I say, they come from different parts of the financial services industry. I think if they didn't see it in their interest, that group would have quickly depleted, but it stayed very cohesive and together. So I think it's in a lot of people's interest to this to happen. You know, using the language enemies or whatever, we don't think of it like that, but certainly we think about, you know, different people may have commercial interests down the road. So, you know, I referred to earlier, there may be parties that go, well, that's very interesting, but I'm busy creating my own marketplace with my own solution over here, and I've got clients, and that's great, and off I go, which is good, which is fine. I think that the thing about FinP2P is it solves a distribution problem that benefits many parties. Some parties will embrace that straight away. Others, it may be that, you know, there may be 2 or 3 years down the road, and then they think that FinP2P might add value to them. So I think it's for anybody who's interested in an open industry-wide approach, this is good. If people are interested in delivering proprietary localized solutions for their own commercial benefit, they may see it as less interesting.
I'm interested, you call it a distribution problem, but listening to you, it seems to me it's much more about creating an open marketplace in which network effects drive growth, which drives liquidity, which drives more growth, which brings me to one last question, which I'd like to ask you, which is, how big do you think this could get? In other words, do you see FinP2P as a sort of workaround, technical workaround, if you like, to a practical problem of lack of interoperability between blockchain networks? Or do you see this as the crucial technological fix, which allows what we call security tokens, what you call digital securities, to actually take off, not just in the private markets, but into the public markets as well? Which of those is it? How big could this get?
Yeah, no, I certainly see it. I think we're at a tipping point for digital securities. The tipping point we've got to is that you've seen it worked in a retail context, but not in an institutional context. We think that FinP2P solves that problem. It's not a workaround. It's a protocol that understands digital securities and always will. And we think that FinP2P is something that can take digital securities over that tipping point and drive a rapid proliferation network effect around private securities in the short term. There's many other initiatives, again, working in the public capital markets. If FinP2P solves a problem for securities in the private markets better than some of the solutions that are in the public markets, then it could also drive adoption there. I think, you know, it's in the next few years, we see it focus very much on the private markets. We think it'd be massive there, and who knows where it will go from there.
Well, at Future of Finance, we're definitely going to be watching it very carefully.